Hello, everyone. This is Jen from the Sage Investing Group. Thank you so much for joining us today. I am really excited to share with you the opportunity to partner with us on this beautiful 354 unit Class A multifamily asset that's located in sunny Orlando, Florida. Before I pass off the webinar to the passive investing team, we thought that it would be valuable to share our thoughts on this classy opportunity from an investor's perspective. For those of you guys who have been following the Sage Investing Group, you'll know that we deeply believe in purchasing value add assets that we can force appreciation into. So, why did we decide to partner on a new built asset? Well, we also see the importance of diversification for ourselves and our other investors out there who have a portfolio similar to ours, filled with mostly B and C class properties. And also for some of our new investors out there who are just getting started in multifamily investing, or maybe for those people who are a little bit more risk averse, we thought that introducing a steady, stable asset would actually make a great introduction for these investors to get started in multifamily investing. Class A assets, they do typically provide investors with more security because you are investing in a top tier property. In this case, what Ascend Water League, which was completed in March 2021. So there is no outstanding issues here that's going to require investors to put in money for further capital expenditures. So for these reasons and more, we decided to move forward and to actually vet this deal. There are three factors that we consider when we vet every deal, and that is the team, the market, and the deal itself. I'm going to briefly share with you our perspective on each of these. Now, the most important factor is really the team. And the reason why we decided to move forward is because we deeply believe in the team. We think they are exceptional and that they are professional, and they've proven time and time again, not just on our project, but on other people's projects as well, that they are able to meet or beat their pro formas. And also, passive investing team, they are really an expert in the class A and B assets in the apartment space. We've worked with the passive investing team on one other deal in the past, and we're actually very pleased with the performance and progress at that property. Believe it or not, we actually have not missed a single monthly distribution since we closed on that property well over a year ago. And given the environment that we've been operating in for more than a year now, it's actually quite hard to do not to miss a distribution. So with that said, I do have to add that past performance is not indicative of future performance. However, we do have some proof that the passive investing team can really deliver on their expectations. So this is the passive investor team's second Class A acquisition in the Orlando market. So they already have a presence here that they can leverage off of. We could not be more confident in the team to successfully execute the business plan for the Ascend Water League and to deliver investment results to our investors. Now the market. Florida is obviously hot, literally and figuratively. It hits a lot of the metrics that we look for in an ideal market to invest in, such as high population growth and strong economy because of its diverse and strong industries in this market. Despite a lot of people's misconception that it's just tourism and theme parks here, we know that's not true. We all know a little bit something about Orlando. We've all heard of it before. And so we just wanted to share with you a few market data points on this market, and we've done so in our email and our investor email. And I know the passive investing team will also talk about this in their webinar. So I don't want to dig into it too much further, but I'm happy to talk more about this market if you have any questions. Just go ahead and schedule a call after the webinar. Now the deal, I would really like to spend a little bit more time talking about the deal itself and why it makes sense and how it differs from our usual investment in Class B and C assets. So there are 3 points I wanted to make here. Number one is that this is a new construction A-class asset, which, as I mentioned before, tends to be more stable and predictable compared to a C-class property that's going to require more of a complex business plan. So for an investment with a simpler business plan, it does mean that the returns are going to be different from what you would expect to see on a C-class property. And I don't want to get into the numbers too much because I know people's eyes kind of glaze over when you talk too many numbers. But the general idea here is that the cash distribution from this asset won't be as high compared to our other C-class properties. However, you're going to see more consistent and more predictable distributions each month, which starts about just about 1 month after closing. The distribution is going to start. So in terms of total returns, you can see a spectrum of those possible returns in the investment deck on page 15. And based on a conservative assumption that the exit rate will be likely 4.28% upon exit, we do expect that we will hit an internal rate of return of 16%, which is actually more than the minimum 15% internal rate of return we aim for in our C-class assets. So the fact that this A-class property can hit that is actually really good. And also, we likely, at a cap rate of 4.28% in 5 years' time, we will also likely be able to double the investor's money upon exit as well. Now, if the talk about cap rate kind of confuses you, don't worry, just schedule a call with us and we'll explain it in more detail. So number two is that with a simpler business plan, there is going to be no renovations that's going to be needed at this property. So there's going to be less surprises during the course of the hold, which translates to that more consistent cash flow I mentioned earlier. Now, the main objective here is to really keep the occupancy high. We expect to take over at a 96% occupancy rate. And so we're going to want to maintain that occupancy rate. And at the same time, we want to continue pushing up the rent to market through lease renewals and new leases. And we also want to improve upon the operational efficiency at this property as well. The rent here is currently about 15 to 18% below market rent. So we looked at other comps in the area and we see that other places that are even a bit older are actually charging more than what we're charging here. So that gives us comfort that there is definitely room to push rent here. So point number three is that for an A-class asset, we were rightfully concerned from the beginning on whether tenants will be able to afford living here in the event of a recession, and we should in the event that the market should incur greater unemployment rates. So what gave us comfort over this concern is that the average per unit rent is only just about $1,600 a month, which is very affordable and reasonable for a brand new luxury apartment community situated in an affluent and growing submarket of Orlando. And as you may know, there are different classes of A-class properties. For example, depending on their proximity to downtown, sometimes the average rent at an A-class property could be $3,000 to $4,000 a month. So we like that although this property is luxurious, we like that it sits in the suburbs, but it's still convenient to a lot of like retail and restaurants and jobs and also medical facilities. And also living here, the rent is really not a stretch for an average white collar worker. The average household income here, in fact, within a 3-mile radius is more than $111,000 a year. And based on our 311 rent to income ratio, someone would just need to make about $57,600 to be able to afford living here in San Waterley. So for all these reasons and a lot more, which I'm happy to go into more detail on offline, we believe in this asset. So for our investors here who are looking for a more consistent cash flowing asset in a really strong market, and then to invest with a really strong team that specializes in A and B class properties, we think this would make a great investment. And so whether you are a new investor, or maybe you're a little bit more risk averse, or maybe you just want to diversify your existing portfolio, this is really a great asset that anyone would be proud to hold in their portfolio. So now I'm going to pass off the webinar to Dan and his team, who's going to share more detail with you. And I will see you at the end once they're done.
All right, welcome everyone to this webinar on Ascend Waterly, which is our next investment opportunity over here at passiveinvesting.com. We're going to get into this property just here in just about 1 to 2 minutes. And while we're waiting on a few more people to get in, what we're going to do is go ahead and share with you a little video about the property. It'll go for about maybe 1 to 2 minutes here, and then we'll get started with the presentation tonight. All right, let's go ahead and get started with the presentation tonight. We are going to be talking about this opportunity, this investment opportunity, which is called Ascend Waterly. And as we're getting started here, if you guys have any questions for us, feel free to reach out to us. Inside of each one of the investment offer memorandums that we send out, we make sure that we can include our direct phone numbers, as you can see here on your screen, as well as our emails. And of course, this is also part of our legal team's slide to be able to provide you with as much information as possible from a disclaimer standpoint. So if you want to stop the video on the recording and read through this, you can. It's the same disclaimers that are inside of the investor OM as well. And here's another little tidbit to include in it as well. Just to mention before we're on this particular topic about the disclaimers, this investment opportunity is open for accredited investors only. So if you want some more information about that, you can certainly reach out to our team. We can provide some more information to you. But in a nutshell, an accredited investor is somebody who has at least $1 million of net worth that does not include their primary residence, or they have $200,000 if they're single, $300,000 if they are married, of annual income for the last 2 years, and they have a reasonable expectation for that to continue. So if you meet one of those qualifications, either one, then you would become qualified as an accredited investor. With this investment offering, you do have to go through a third-party accreditation, whether it be through a third party. On our end, we use a company called Verify Investor. We do pay for those costs for you, or you can send in a letter from your CPA or attorney, your financial advisor, letting us know that you are an accredited investor, and that would qualify for it as well. So both of those are an option for you. Again, I want to introduce our team a little bit to you. So I'll introduce myself, and then I'll turn it over to Danny, and then Dan will turn it over to Brandon here. But I'm Dan Hanford. I'm one of the managing partners here at passiveinvesting.com. And I live here in Columbia, South Carolina, along with my 4 children. There's this fly trying to get in my face. Along with my 4 children and our little dog, I say, is a standard poodle named Bella. We are really excited to be part of the passiveinvesting.com team, and be my primary role in the group is on the investor relations side, and also some of the overall strategic objectives of pushing the company and things like that. And I'm going to go ahead and turn it over to Danny, let him talk about his introduction here, and then have him turn it over to Brandon.
Hey, thank you everyone for joining us on this investment opportunity webinar. I am Danny Randazzo. My wife and I, along with our daughter, reside in Charleston, South Carolina. So about an hour and a half or so from Dan and Brandon in Columbia. In Charleston, my wife and I love taking walks. We have a golden doodle dog named George. And so we're usually out and about around Colonial Lake enjoying that. Within the company, I am over our finance and asset management. So anything to do with the numbers, my email is on the screen right there. If you do have questions, don't hesitate to ask, and look forward to partnering with you on this opportunity. Brandon?
All right, good evening, everyone. Welcome to this presentation. As Dan and Danny mentioned, I reside in Columbia, technically West Columbia, with my wife and 4 daughters. They're all having birthdays within the next couple of weeks, so I will have a 16-year-old, 14-year-old, 13-year-old, and 10-year-old girls. So my oldest is currently in driver's ed and is going to get her license next week. So exciting times with the Abbott household. We have a multiplicity of pets, dogs and rabbits and whatnot. My background is in construction and insurance, and I head up the acquisitions team and handle dispositions, CapEx, and work alongside Danny with asset management and our team there. So we're very excited to bring this opportunity to you tonight, and we'll go ahead and get right into it.
Awesome. Thank you so much for that, gentlemen. And right as we get started here, I want to give you kind of some highlights of this property so you can actually see a little bit about why we are so excited about this acquisition. So first off, as you can see here, it's 354 units. It was actually started to be opened up for leasing back in 2020, in March of 2020. And consistently, even though March of 2020 was kind of the beginning of the pandemic, even through the pandemic, they were able to get in 30 plus leases every single month in this particular submarket there in the Orlando MSA, which is really exciting. And you're going to see that throughout this entire presentation, the story behind the lease up and why there's an actual value add opportunity that's part of this property, even though it's brand new and built. And we're not talking about construction. We're not trying to doing renovations on a brand new build, but we're going to touch on a few areas that will be very exciting as to why we are really excited about this opportunity. One thing you can see here is that the average market rent per square foot is $1.47. And what's important to note about that is way under market by about 15 to 18%. And so it's great for us because we can go in there and they already have right now leases that are being renewed at over 10% of their original lease price. And the reason why is because as a merchant build like this one is, the developer's goal is to get that thing leased up as fast as possible. And so they're not usually trying to get the highest market rents. They're just trying to get as many people in there in that property as possible. And then that leaves an opportunity for us buying it from the developer to go in there, improve the operational deficiencies, and also go in there and to be able to increase the rents to the current market rents over time as the leases are being renewed. You can see there it says 90% occupancy as of April 29th, which is great for this particular property. But what's going to be really exciting is by the time we take over this property, it'll be 96, 97% occupied when we take it over. And so that means it's going to be about a 3 to 4% vacancy rate when we take it over. And we actually underwrote this particular property with a 6.5% vacancy. And so you're going to see in this particular presentation, again, why we're so excited about it and why this particular property in this submarket in Florida, in this Horizon West submarket, is so exciting to us. So talking a little bit about the demographics here, one key thing I wanted to point out, really kind of two of them, is on the right there, you can see that 22.5% annual growth from 2010 to 2020. Now, I want you to really let that sink in for just a minute, because a lot of times when we see that number of 22.5% or sometimes 15, 20, 30% right there, we think that that's the overall growth from 2010 to 2020. It's like the 10-year growth, right? Well, this area has had that 22.5% annual growth from 2010 to 2020, and it is going to continue to be sustained like that. And you're going to see all the new developments that are happening around this property, and also you're going to see some conservation easement lands that's causing this property to be landlocked as well. So make sure that you stay tuned for some of those things as well. So the second thing I wanted to point out here is the 2020 average household income within a 3-mile radius of this property. So you can see that there it's 111,000 for the 3-mile radius. And of course, the 1-mile radius is 96,000. So that kind of $96,000 to $111,000 range is letting you kind of understand the quality of the surrounding market. And if you know anything about Orlando, this kind of Western hemisphere of Orlando, that kind of Windermere area is really kind of Windermere is just to the east of this particular property. And when you look at the Orlando MSA, that Windermere area is kind of like the high end area of Orlando. You tell anybody in Orlando you're from Windermere, they think, highfalutin, right? It's kind of an affluent area. And that affluent area of Windermere has just pushed more and more west. And that's really kind of why they decided to put in the 429, which you're going to see as Brandon goes through some of the market studies here as well. So talking about the return structure real quick, I know several of you have already seen some of our offerings in the past. And so we do have a dual tier or a 2-tiered equity structure, which allows you to be able to decide whether you want the higher cash flows on the Class A at 9%. But then when you have those higher cash flows, there's no participation in the upside, but you do have a preferential treatment in the capital stack. So it's a little bit lower risk investment because the Class A investors get paid first, and then the Class B investors get paid secondarily to Class A. Now, the Class B investors, you can see there, the preferred return is 7%, and you'll see that the after the 7% is achieved, then there's a 70-30 split after that, and then once a 13% IRR is achieved, then it splits to 50-50. This is all described here on this page, which is actually page 14 inside your investor offering memorandum. I know it says page 12 here on this one, but it's not. In your investor offering memorandum, it's actually page 14. Then page 15 in your documents will also show you this table here, which is the breakdown year by year. The thing I wanted to point out here is sometimes people get a little bit confused about the return summary, and I want to kind of give you kind of our realistic expectations as to where we feel like we can achieve on this property, because I think it's important to note here. So let me pull out my annotator here so I can be not drawing, but showing you on the screen here. So if you look down here at the return summary section, what we do to share with you kind of what the projected or the potential opportunities for growth on this property is we give you a variety of different what we call exit cap rate scenarios. And so this middle one, this 4.03%, is the exit scenario at the same as our entry. So we're buying this at about a 4.03% cap rate as we're buying it. And you can see if we exit at the entry, you can see that the IRR would be at 19.1%. The equity multiple is at 2.25. And then, of course, the annualized return is 25.1. Now, the likelihood that we feel like it's going to go below that, it's possible, especially with all the growth that's happening in this market. It might go down a little bit, maybe 10 or 15 basis points. But if it goes even further than that, you can kind of see what it does here from the IRR, equity multiple, and the annualized perspective. But really, realistically, it's going to probably trade between that kind of 4.5% to 4% cap rate. And you can see here the different scenarios would be basically between 13.7 to a 19.1 IRR, equity multiple 1.8 to 2.25, and then the annualized going from 16% to 25.1%. So, definitely some great opportunities here. Lots of opportunity for growth, especially on that net operating income in years 1 and 2 to really get this property stabilized to the best NOI possible. So it's a very exciting opportunity. I'm really excited about it, and looking forward to going over some of the market statistics here as well with you as we continue to move forward. All right, I'm going to turn it over to Brandon, let him go over some of these market highlights, and then when he's finished, he'll turn it over to Danny.
All right, thanks, Dan. So our acquisitions team, Eric and Chris and myself, spent the last week in Florida, touring all of our major markets, starting in Tampa, going over to Orlando, and then over to Jacksonville. And we spent a lot of time in Orlando, a couple of days, mainly looking again at this asset. We had toured it a couple of weeks ago, but just getting a better sense of the market and other comps. So we toured several other deals in the area, and I can tell you from what we looked at, this is a phenomenal location at a phenomenal basis. That's our per door basis. Monte Rosso is our last deal that came out in Orlando. It's a $255 a door. This one's at $258 a door. All of the other properties that we're looking at have already moved to, above 260 to 270, 280 per door for like quality assets. So we're getting this at a phenomenal rate and a phenomenal location. So as Dan mentioned, you see Ascend Waterley down there on the lower part there with the little asterisks. You see the 429. Disney's actually working on making that the main entrance into the park right now. When everybody comes in, they're kind of coming in from this number 4 in this Florida Turnpike. And the first thing they see is Universal Studios. So Disney, with their authority and power, are trying to change it to come in on the 429. And so the first thing they see is Disney. So we are right on the 429. And as you can see, we're right next to there. So tons and tons of traffic. This is a place, the quality of this asset is one in which that we have high level people. We do have some people that work at Disney, but they're management high level. They're not, concession stand or people that were affected as much by the pandemic. So we really didn't see any effect in that. And there's many other employers as we get into this that drive our resident demographic. So you see here we have a lot going on in the community: golf and hospitals, parks and rec, entertainment, schools. When we get to the map, you'll see there's schools being built right next door to this property. So the Winter Garden area is really phenomenal. Our Monte Rosso deal is just to the south and a little bit to the east of this, just off the screen there of what you're seeing there. So great area. Dan, if you want to go ahead and flip it to the next screen. All right, so Waterley is the planned development that's developed by D.R. Horton. And D.R. Horton is the actual seller of this. This is their very first multifamily sale. So we are the first ones to buy from D.R. Horton. They are traditionally a residential builder. So raise your hand in the group if you've ever heard of D.R. Horton. They're very well known. So they are used to high quality finishes. Yep, we got everybody raising their hands, so that's great. High quality finishes. And so we're getting a very nice asset above market specs, because these aren't your typical commodity builders, merchant builders. They're new to the scene. They can get good products, high volume. This is a 1,500 acre site right across the street from us. It's amazing. And they've got all kinds of amenities and greenways. So that's across Flamingo Crossing development, the Walt Disney World mixed use development, 750 hotel rooms across. So there's a lot of going on. The Disney expansion for Galaxy's Edge, 14 acre Star Wars theme park that was recently completed. So they continue to grow. They're almost fully open, and I believe they're right at 100% now. And as restrictions lift, they continue to get back to normal. They have begun to rehire again some of their workers on the park side, concessions and ride operators and such. So we're getting back to normal there. But again, that doesn't really affect our property. We're dealing more with management level and executive level people in our resident demographic. And then you have the Hamlin development, Horizon West, 640 acre community, single family homes and medical offices. This is a very residential area. So there's not as much multifamily supply. It's very residential, but this is a very nice garden surface park community. Ascend Waterley is, and it's the next best thing to buying a home as the inventory is so low in the national market and people are unable to buy homes. Prices are going above market, well above market. Houses are on the market for 24 hours and are going for 10 to 50,000 over asking price. People are just assigning themselves, say, I'm just going to rent for now, wait for the market to cool off. And we've seen that in our portfolio across the board in every state that we're in. Vacancy is down, occupancy is up. People are, they're not going to pay those crazy prices for houses. So it's a great place to be in that nice residential area because it's where people want to live if they could get single family homes. But this next best thing, they don't have to worry about the yard keep and everything else. So great location. If you want to go ahead and fast forward to the next slide. Again, Horizon West, kind of in that Winter Garden neighborhood, just tons of growth. Flamingo Crossing, we already talked about. Winter Garden Village. I saw this as I came in, and as I went and toured other properties, the broker's like, just follow me. I'm going to take you on a longer route. I want to show you the development that's going on. And there's just cranes and retail is going in. It hasn't slowed at all. The growth in this area is just unexplicable. It's really great to see. And if any of you have a chance to go or in Orlando and see the growth that's occurring in the Winter Garden Market, you will be amazed at it. Just grocery stores and retail. Disney Springs is right around the corner, 20 minutes. When we went to the NMHC, the Multifamily Housing Council, 2 years ago now, this is pre-COVID, we ate at Disney Springs. This is well open to the public, lots of restaurants, lots of fine dining there. A lot of people go there from the area. We can go ahead and go to the next. All right, this is a great slide. I love this slide because it kind of gives you the lay of the land, and we really want to see where we're sitting. So you see Ascend Waterly right there in the middle. So Walt Disney Parks and Resorts own land right here. Obviously, they're not going to build a theme park on that. That's going to be retail that they're planning there. Across the street from the Walt Disney, you have the Future Horizon West High School. Look at opening 2022. That's opening next school year. Brand new high school right across the street from our beautiful property right here. So you couldn't ask for a better location. And then if you go to the right of Ascend Waterloo, you've got the brand new Publix, again, right across the street from where we are. So almost becomes a walkable location, but it's garden. This is suburban garden, surface park product at the top of the amenity list, Class A amenities, right across from the Publix, right across from the high school. Kind of locked in. You see the conservation land to the north. So nothing's going to be built there. But, we're not going to get supply right next to us. The Disney parks, we're not going to get supply there. We're locked in there. If you look down in the bottom right corner, there's your DR Horton 1,400 acre development, 300K plus homes. So very high end. And as you pull out of our neighborhood, you look right across at this huge, massive development with a waterfall entrance and everything else. It's all single family, all high end single family homes. So you could not ask for a better location for Ascend Waterley. As Dan mentioned, not only is the location great, but the basis that we're buying it at is phenomenal. The rent per square foot is well below market. We're going to get into the comps a little bit later. Danny's going to show you that, but we're so far below market on a sales comp level and on a rent per square foot level. We're just can't be more excited about this deal. We were looking at it early on. As soon as it came out, we were on it. We underwrote it. We actually bid on this early because we were so confident in the returns, and we've done more research, I think, on this property than we ever have. We've toured it multiple times, spent time in the market. We have multiple versions of underwriting, just making sure we had all the boxes checked, and we're very, very conservative. Dan mentioned that at takeover, we're going to be at 96, 97%, and we've underwritten a 6.5% vacancy on takeover and on stabilization. So we're already achieving beyond what we have projected. So very excited about that. Dan, if you want to go to the next slide. All right, just a further overview. You see the Hamlin Town Center we talked about a little bit ago. That's all this retail also going in. I saw this being built. There's just so much. There's so much going on. It's just massive construction, but it's not. The good thing is it's not multifamily. It's all drivers, market drivers, economic drivers. And then the big thing is this Orlando Health ER Medical Pavilion, 103 beds. So that's going to be a lot of our resident base. Hopefully we'll be from there. We have a good demographic mix in all different aspects of the economy in the area. But again, just a great location right off of the 429. You can see it right there. That's going to be, again, the main entrance. If you see these little sand square things that down there, a lot of people have questions about that. That's part of the aquifer system in Orlando. If you notice, there's a lot of little lakes, a lot of little water. They've got to control all that. We're not in the floodplain, but they have all these as kind of retention or detention areas for the water. So that's what that is. So nothing will ever be built there either. All right, if you want to go on to the next one. All right, and again, just your typical unit mix. We'd like to see this 1 bedroom, 2 bedroom, and a smaller sliver of the 3 bedroom, because once you get a lot too big of a slice of 3 bedroom, then you get people that are transitioning into single family homes with a larger family. They need larger. So we want the majority of our unit mix being in the 1s and 2 bedrooms. So we love this unit mix here. All right. And amenities, I cannot describe them well enough. You have to really see it. The video, I apologize, there was no sound on that. And I know it's hard to stream it over video. We will be sending that out, but it really gives you a feel. Again, this is D.R. Horton. This is their very first multifamily sale. And so they're new to this. So they're building, kind of overbuilding and selling at a lower basis. Everybody always wants to ask, why is the seller exiting? It's because that's their business model. They're building this. This is merchant build. They build it to sell. They get it stabilized or just right before stabilization and sell it. So this is their business plan, and they really put all the bells and whistles on. I mean, look at that pool. You feel like you're at a resort. Just beautiful. It's heated. It's salt water. There's cabanas all around. There's grill areas everywhere inside the clubhouse. I mean, it's like a hotel lounge inside of the clubhouse. Just beautiful. And you can see in the top picture, you can actually look out to the pool. As soon as you walk in, if you're ready to lease, you walk in and you see that beautiful pool right out the back. And the fitness center, they didn't spare anything on it. They've got the full rack weights and dumbbells, free weights, and all the equipment that you would need. Plus, they have a spin room that's not pictured there. Just tons and tons of amenities that anybody living on this would be happy to use. So very excited to bring this to you. Go to the next one. All right, and I will go ahead and hand it over to Danny.
Thank you. All right, so a couple of quick highlights here from a financial perspective. As Dan mentioned, about a 4 cap on the entry, expense ratio right in line where we would expect this to be at about 41%. Occupancy as of just a few days ago was at 90%. Total purchase price on this one, $91.6 million, 5-year hold. We're going to raise about 32 million. And let's move on to the next slide. We will be acquiring some debt to purchase this property. So we'll get a private loan, very competitive in the market space right now, about 68.8 million. That works out to be about a 75% LTV on the purchase price. Interest rate will come in at about 3.5%. It is an adjustable private loan, so we will be buying a rate cap to mitigate any upward interest rate movement to keep ourselves protected and make sure this deal is conservative. So a couple of main highlights from a pro forma projection and just looking at the T12 numbers. So the biggest change when you're comparing these top line income numbers, so there's 6 items here. The biggest change that we're projecting is just from a vacancy perspective. So as Dan mentioned, they started to lease up this product or this property, from 0% back in March of 2020. And today they're at about 90%. So we will have a new adjustment for the vacancy. So that's really the biggest driver from the year 1 compared to the T12 effective gross income. We will see some other income increase, but that's just from a natural occupancy growth. As the units are occupied, everyone will be paying their other fees that they are charged, which equate into that other income bucket. So from a expense projection, one of the items, payroll, it's going to remain about the same. Contract services, again, roughly the same. We will have some more repair and maintenance and turnover because the seller, the previous owner, was the developer. They had a much lower repair and maintenance and turnover perspective because they didn't have many units that were being turned over because they were still in the lease up phase. One of the other biggest items that we are going to have in the change when you look at the T12 to the year 1 number is property taxes. So the property currently is assessed based on the raw dirt. And in this county in Florida, they reassess once the property has been CO'd. And so they finally received all of their COs and it will be reassessed for this year. So we've projected that new reassessment, and that tax equation equates to an expense of 1.2 million for our tax bill. So when you're comparing the overall net operating income from year one against the T12, we are projecting it to be at a little bit of a decrease. Again, we want to remain conservative in our approach to this investment, and we will see a large tax bill increase for this property, and we will see some natural income increases. But overall, year one, we're going to be conservative, and we're going to be doing about the same income generation. So where we really can get into optimizing and increasing the value of this asset is as we hold it longer and naturally turn over the residents and turn over those leases into new market rent leases. And I'm going to get into the market rents when I talk about the rent comps on the next slide. So from a rent comp perspective, one of the big things, Dan highlighted it early on, the current rent per square foot at the property is $1.47 per square foot. All of these other comps, you can see 173 being the highest, and then about $1.58 being the next closest competitor. So these properties, like kind assets, Ascend at Waterley, great location, great property, very well built. So again, we can be conservative. We can really push our rents as we're leasing this property and organically increase the income that we generate just because we are trailing in the market. Again, the big reason why we're trailing is the goal of this owner and the seller is to get the property leased up as quickly as possible so they can sell it off and move on to their next project. Let's move on to the next slide, and we'll talk about some of the sales comps. So Brandon had mentioned we're really coming into this property at a good basis at about $258,000 per unit. Some of the other comps here, 264, 300,000 per unit, and another one that sold in 2019. So roughly 2 years ago, sold for 253,000 a unit. So a good basis to be in this market with all of the growth that's coming. Let's move on to the next one, please. From a break-even perspective, again, we want to be conservative in all of the numbers and the underwriting that we do so we can achieve the business model. And our break-even is at right about 60%. And so the break-even means if 60% of the residents are occupying the units and paying their rent, we will collect enough income to pay for all of the property expenses and all of the debt service for this property. From a cap rate perspective, as Dan mentioned earlier on, we should be looking around this 4 cap range if we enter where we exit. But more than likely, it'll be somewhere maybe in that 4.25 or 4.5 range. So a 13 IRR to maybe around a 19 IRR for Class B investors over the course of the 5-year hold. Let's go to the next one. FCA will be managing the property. We've got a great relationship with the team. They manage a property right down the street in the Orlando area. They'll also be managing the Monte Rosso for us. So we'll have some great economies of scale. And they've done a phenomenal job in managing these properties through the pandemic and also since we've been working with them over the last couple of years.
All right, that's the end of the presentation. So we're going to go ahead and open up the floor here for some questions from those of you who have joined us live. And I know there's a few other things that we'll probably add in here as well. But first off, I'm going to open it to Brandon. There's a couple of questions in here that I'm going to gear towards you. And so Jay's asking, Orlando's expanding every day. Are there any new multifamily units being built in close proximity to this property?
Yeah, there's actually one right across the street from this one. Vintage is right across the street. They're getting ready to release that deal and start leasing up. Their rents, even with their concessions, are way higher than our rents. So that's a good thing because we'll be able to come in and beat our projections and not be hurt by what they're trying to achieve. And some of our vacancy projections at that 6.5% is being conservative because of that supply coming in the market. So we look at our expiration report for June, July, and August and see how many leases we have to renew during that time period. And so we're looking to have to do about 20, between, I think it was between June and July, we'll have to do 20 leases combined. And that's not very much because through the pandemic, they were doing 30 leases per month. And so we're in a much better time frame in the economy. So even with that new supply, I don't see any issues there.
The other thing that's important to add, just from a leasing perspective and a resident or just sheer population base, with the average household income in the 1 mile radius being $96,000, and in the, I think, 3 and 5 mile, it was just over 110,000. To live at this property where the average rent is about $1,600 a month, residents would need to make about 60 grand a year to qualify, with that rule of thumb of being 3 times the income of your monthly rent in order to qualify for it. So again, it's a conservative in nature of just having affordable rents for folks, and people are earning a lot higher salaries in this general area within the 1, the 3, and the 5 mile range compared to the average monthly rent.
Another question coming in here is for you as well, Brandon, and I'd like for you to kind of expound upon this just a little bit as far as the cap rate, because we mentioned kind of the entry cap rate is that kind of 4.03, and it's really an adjusted cap rate that we adjusted based on the current cap rates in the market for these types of properties. But the going in cap rate is actually quite a bit higher than that because of the great basis that we're actually buying this property. So Jay's asking another question here about what is the current cap rate for Class A properties in this particular market?
Yeah, so for pre-stabilized deals, it's a little bit different because when we put in the financials, it's not fully occupied. So if you base it on the GPR, the gross potential rents of the financials at the current vacancy or occupancy levels that it is when we underwrite the property, your cap rate is going to be like a 2.5, because it doesn't make sense based on what you're buying it for and the low financials pre-stabilization, right? So we have to adjust that based on the market. So 4 to 4.1 is right where market is across the board. We've underwritten a lot of deals in the Florida market pretty consistently right at that. So we set that as the entry cap because of what the market is. So that is actually the set. Year one, we're achieving much, much better than that. I think 4.65 based on, what we will be achieving once we're stabilized, once we get the other income items in there. So that may sound low, but for this type of deal, a brand new deal, that's actually what we're seeing across the market.
Good. I don't have any other further questions in here. Does anybody, Danny or Brian, have anything else to be able to add in here that maybe we might have missed?
I just saw in the chat, I know that we touched on, why is the seller or builder selling? I'll just reiterate that this is their business model, is to build and to sell. So it's not to hold it. It's not to manage it. They are a single family developer. So they're used to just done, just production line, get it out the door. And that's what they've done here. They've brought it up. They've done a great job leasing it up. This is being managed by Greystar. They are a machine when it comes to lease ups, but they do not push rents. So they get it occupied really quick, sell it off, and move on to the next project, as we mentioned earlier. So there's a lot of room to move. So that's a good thing for us. And I think there's maybe a couple other questions in there that you may want to touch on, Dan.
Sure. And there's actually a couple of questions in here. One of them in here is for Danny. For the private loan, what's the cap rate of the adjustable loan, or the rate cap?
The rate cap, yeah. So we will work very closely with the lender to make sure, and typically what the lenders like to see is a buyer acquiring a rate cap of 1.5% interest coverage. And so what that means is if we're getting a loan at 3.5% and we buy a rate cap at 1.5%, if interest rates were to move up to 4 or 4.5 total, we would be paying that higher interest rate, but we would be capped at the 3.5 plus the 1.5. So we'd be capped at a 5% interest rate maximum that we would pay over the duration of that rate cap.
Good. And I have another question coming in here for the Class B investors. I'll take this one. Can you go over the return schedule with me one more time? So I'm gonna go ahead and share with you this screen here, which is the page. It's actually page 15 in the investment offering memorandum that you have received. The top here is the Class A investment. So you have here 1, 2, 3, 4, and 5 cash flows, and you can see it's 9% because it's a 9% preferred return, and those are paid out monthly. And then on the Class B, you can see the annual percentage return for years 1 through 5. Starts out in year 1 at 5.1%, and then goes 6.8, 6.9, 7.5, and 8.2. And that's the amount of the annual cash on cash that you will receive during the whole period of this investment. And then, of course, when we sell, based on the bottom table here, which is the exit cap rate scenario sensitivity analysis, if you will, we'll share with you kind of what your annualized return would be, when we actually exit or sell this property. And again, one more thing to point out: the Class A investor, they're only getting 9%, so there's no participation in the upside when we sell. So you'll see on a $1 million investment, they're going to receive 9%, which would be $90,000 per year. And then the year 5, when we sell, they'll receive their $1 million capital investment back. And so you'll see that total will be that $1,090,000 in year 5. And that's exactly what that is explaining there. And then you can see down here in this year 1 through 5, the total return year over year. And then it says, of course, C below for year 5, because that's going to be this right here, this return on disposition based on the different exit cap rate scenarios, if you will. So hopefully that's a little bit, that gives you a little bit better understanding of that. Another question here is about the anticipated time of the first distribution. So the first distribution, since we're closing this one right now, we're projected to close this the week of June 21st. So because we are closing it in the end of June, we will be waiting until we have the first full month of July under our belt. And so the first distribution on this will be in August. And that August distribution will cover the prorated time that we owned the property in June, and then the full month of July. And then ongoing from that point forward, you will receive your monthly distributions based on the projections that are listed here on this particular page. So, and yes, the anticipated exit strategy is 5 years. So there is a potential to be able to exit a little bit sooner. So that is possible. But you also have to understand it might take a little bit longer. So, but the projections are based off of 5 years. So 3 to 5 years is kind of being a BR target, but it is possible, depending on market conditions, that we might have to hold it for a little bit longer, but it's not what we're anticipating at this particular point in time. Our goal will be to try to exit this during that kind of 3 to 5 year exit scenario, if you will.
Mm-hmm.
All right.
Another question about how this compares to our other Orlando deal. That's a great question. It's a different type of asset. The other one is a mid-rise elevator deal. Okay, so you're multiple stories with elevator conditioned corridors. And this one is a garden, right? So you have breezeways, open corridors. This one's really well done, though. It's kind of, instead of having those long corridors where you kind of walk down, there's doors on every side. These are kind of like almost coves. Like you go in and there's like 1, 2, 3, 4 doors all right there at you. So you don't have to walk down this long hallway. So very nice, but just different product than the Monte Rosso deal. And the basis, Monte Rosso is 255. This one's 258. And some people would say, well, why was the elevator deal 255, less than this one at 258? The amenities, because it is garden, it's less dense, so it's more spread out. They have more land, so there's more green space, more ability to expand the amenities, and so there's a little bit extra premium for that. And then it is more suburban, and it's a little bit closer to the retail. So that's where you see that maybe $3,000 difference in the per door basis from Monte Rosso. But both Class A amenities, and what we love about this, and is that we're trying to build the units in the market so that we can have a regional manager that is in the market specifically just for this market. So that's why we love having this property. And as we mentioned, FCA has another property very close by. With the combination of those 3 units, they can have a regional manager dedicated to these 3 properties. They're other one that they're managing and these other 2, which just means they have more attention to occupancy, more attention to rent premiums, more attention to other income, instead of being diversified. Whereas if we only had 1 in the market, they're having to pay attention to the Carolinas and to Florida. So we really love that in the economies of scale, is the focus on operations.
Well, gentlemen, that is all the questions that have come in. So for those of you who have joined us here live, or for those of you who might be watching the recording, we try to be as open with you as possible. So if you have any questions whatsoever, feel free to reach out to us, phone, email. We try to be as accessible to you as possible. So thank you so much for joining us for this webinar. We look forward to having you partner with us and join us with this investment opportunity called Ascend Waterly in the Orlando MSA. So I hope you have a great rest of your night. Again, thank you so much for joining us.
Thank you, everybody.
Thank you.
Thank you so much, Dan, Brandon, and Danny, for that super informative webinar. Now that wraps it up for our investor webinar presentation on Ascend Waterly, located in Orlando, Florida. If you would like to express your interest in investing or to get on our email list to receive future investment opportunities from us, please send us an email at info@sageinvestinggroup.com. Remember, the Sage Investing Group, we're here for you every step of the way to help you get started and grow your multifamily investments. Thank you and have a wonderful rest of the day, and I will talk to you soon. Bye-bye.